Hello everyone, you're very welcome back to the channel. Today we're talking about so-called cuckoo funds. Specifically, we're addressing the popular notion that cuckoo funds are a leading contributor to the Irish housing crisis. Headlines such as this would have you believe that the sole objective of these funds is to squeeze prospective homebuyers out of the market by outbidding them for newly built homes. Don't get me wrong, this does happen. You might remember back in 2021 when a multi-billion-dollar real estate investment firm called Roundhill Capital purchased 135 out of 170 newly built homes in Maynooth. The intention was to put these homes on the rental market. While the deal was never finalised and the homes were put back on the market, it caused such controversy that the government introduced a 10% stamp duty tax on bulk purchases of residential property, excluding apartments. This was done to disincentivise the practice of bulk purchasing, with the exception of bulk purchased homes that were to be leased back to local authorities or approved housing bodies for the provision of social housing, in which case there would be a refund of higher rate stamp duty. Nonetheless, this incident really solidified Ireland's perspective on cuckoo funds, and since then, any mention of cuckoo funds in Irish discourse is met with great animosity, similar to the animosity held towards individual landlords, which we discussed in a previous video. Even the term cuckoo fund has negative connotations, as it suggests that these investment funds are elbowing first-time buyers out of the housing market, just like how cuckoos elbow the eggs of other birds out of their nest. The implication is that the investment fund, just like the cuckoo, is taking the property for themselves without ever giving first-time buyers a chance to purchase. So, all in the name of healthy debate, I want to challenge this notion that investment funds are bad news for the Irish property market. My aim is to highlight the reasons why institutional investment in the Irish property market is not only a good thing, but a downright necessity for solving the Irish housing crisis. I'll provide evidence that shows that bulk purchases of completed homes is not the primary function of institutional investors in the Irish property market, despite the Irish public believing it is. I hope to offer up an alternative and less discussed perspective on this topic. I would encourage you to try to hear the other side of the story with some degree of objectivity, and please feel free to share your perspective on this topic in the comments section. I want to begin by outlining the government's perspective on institutional investment in the Irish property market. You've no doubt heard about Housing for All, which is the government's plan to improve the Irish housing system. The housing supply target under Housing for All is an average of 33,000 new homes per year to 2030. This target aligns with a Department of Finance report published in early 2019, which estimated the medium-term annual demand for housing in Ireland to be between 30 and 35,000 units. The government has estimated that in order to provide 33,000 homes every year to 2030, an investment of €12 billion per year will be required. Of this, €10 billion per year, or approximately 83% of the total investment, will be required from institutional investors. For context, the current level of institutional investment in the Irish property market is €6 billion per year, meaning if the Housing for All targets are to be met, Ireland needs an additional €4 billion in annual investment by institutional investors, an increase of 67%. From these estimations alone, it becomes readily apparent that, contrary to popular Irish discourse, institutional investment in the Irish property market is of critical importance to the provision of housing supply. Not only that, institutional investment needs to increase by 67% in order to satisfy the housing demand. But yet, at the current insufficient institutional investment level of €6 billion, opposition government, news outlets, and the general public en masse have seemingly concluded that these so-called cuckoo funds are actually contributing to the Irish housing crisis. But here's the question that's not being answered. If not through institutional investment, how else would you suggest the government comes up with the additional €10 billion per annum that's needed to build 33,000 homes per year? You could make a case to borrow from the banks. The banks could fund the construction of housing by extending loans to developers, and they could also fund the purchase of properties by providing mortgages to home buyers. Here's the problem. The Department of Finance ran a hypothetical scenario where 50,000 homes were demanded and supplied annually by 2024. In order to provide the loans necessary to fund both construction and purchase, the loan to deposit ratio of the Irish banking system would need to increase to 1.6 from its current level of 0.3. 1.8, an increase of 100%. When the loan to deposit ratio exceeds 1.0, that means the banks are funding loans with a combination of borrowed money and customer deposits. A ratio of 1.6 arising from property market loans would tie the stability of the Irish banking system too closely to the natural fluctuations of property investment. In other words, a property market crash could spell disaster for the Irish banking system if too much reliance is placed on the banks for funding. You could also make the case for the government to raise money for property construction in the bond market. Ireland's gross national debt at the end of January 2023 was €235.9 billion. In the Department of Finance's annual report on public debt in Ireland, it was noted that Ireland has one of the highest per capita debt burdens in the world, at just over €44,000 for every man, woman and child in the country. If the government were to fund housing supply via the bond market, our debt burden would rise significantly. Worse yet, with interest rates at levels not seen since 2008, the cost of that debt, i.e. the interest payments, will be significantly higher than the cost of Ireland's existing debt. In fact, according to the report, 75% of Ireland's national debt is set at rates below 2%, and the vast majority of this debt is fixed rate debt. 30% of Ireland's national debt is set to mature in the next 5 years, and as that happens, the government will refinance at higher rates. Issuing government bonds to fund property construction over that same time period would only serve to exacerbate the cost. That's before we even consider Ireland's over-reliance on corporate tax receipts and the cost of an aging population, both of which could contribute to large budget deficits in the future, which would warrant new issuances of government bonds, which again would likely be at higher interest rates. Institutional investment in the Irish property market solves a major problem for the government: the problem of funding. The money required to provide the housing supply that everyone so desperately wants has to come from somewhere. And no matter what your opinion is on institutional investors, there's no denying that they provide crucial funding. Because of institutional investors, we can reduce our reliance on the banking system, which safeguards the stability of the financial system as a whole. Institutional investment also mitigates the need to raise money through the issuance of government bonds, which in turn prevents our national debt from getting any larger. With all of that being said, let's take a look at what the data says about institutional investment in the Irish property market. I'll be referencing three sources of information: the Department of Finance's 2019 report on institutional investment in the housing market, the Department of Finance's 2019 report on REITs, IREFs and Section 110s as they invest in the Irish property market, and an Irish Times article from September 2020 by Ken MacDonald entitled "Institutional Investors are Playing a Key Role in Providing Housing for All." The question that we want to answer from this data is the following: are prospective homebuyers being crowded out of the housing market by institutional investors? Between 2015 and 2019, 8.51% of home purchases were made by pension funds and institutional investors. Homebuyers and local authorities accounted for 78.75% of home purchases during this period. Proportionately, 2015 was the lowest year for institutional purchases, accounting for 3.62%, while 2017 was the highest year, accounting for 12.57%. This gives you an idea of the proportionate size of institutional investment in the Irish property market relative to the purchasing activity of home buyers and local authorities. The Department of Finance noted in 2019 that institutional investors had been net sellers in the property market every year since 2010, meaning institutional investors sold more properties to the household market than it purchased from it. The data doesn't suggest that institutional investors are purchasing as much housing stock as the public perceives them to be, but the paper does note that institutional investors are playing a significant role in the market for apartments, specifically the market for new apartments. This is where we can refine our question: are prospective home buyers being crowded out of the market for new apartments by institutional investors? Over 40% of all new apartments are purchased by institutional investors, while over 50% of new apartments are sold between institutional investors, so they remain within institutional ownership. If you're asking whether more first-time buyers would have been able to buy those apartments had they not been in the hands of institutional investors, the answer is obviously yes. However, this line of thinking ignores two key factors. The first factor is that institutional investors are increasingly using forward funding agreements to invest in the Irish property market. A forward funding agreement agreement is where an institutional investor agrees to purchase a finished product from a developer. For example, a finished block of new apartments. The investor purchases the site before construction begins and they finance the entire development of the project. In many cases, these apartments would not have been built if it weren't for the funding provided by the institutional investors. How can you crowd out prospective homebuyers with forward-funded apartments if the apartments themselves wouldn't have existed in the first place without your forward funding? Would you rather have apartments to rent or no apartments at all? Sure, the construction could be financed via bank loans, but that loops back to the problem of an over-reliance on the banking system for funding. And make no mistake about it, Ireland needs apartments. From the Department of Finance's paper, just 12% of the dwellings in Ireland are apartments, 75% lower than the EU average. If Ireland was in line with the EU average, there would be 800,000 apartments in the country. That would require 600,000 more apartments than are currently available at present. Dublin's apartment stock is only a third of the average size of many of its peer cities, including Copenhagen, Brussels, Zurich, and Amsterdam. So while there may be a perception that institutional investors are crowding out prospective home buyers from the new apartment market, the reality is that they're simply forward funding projects that might not have otherwise existed. Regardless of whether or not these apartments are available for purchase, they are needed. Rental accommodation is better than no accommodation at all. Why else do you think the higher rate of stamp duty doesn't apply to bulk purchases of apartments? In fact, forward funding agreements are only going to increase in popularity among institutional investors in the coming years, specifically for housing construction. That's because an institutional investor who forward funds a residential development can avoid the 10% stamp duty tax that would apply if the same investor came in at the end of the project and bought the completed properties. This, in my eyes, is fair. The tax law is encouraging institutional investors to fund housing projects from start to finish, projects that might not have otherwise existed. The tax law is discouraging investors from swooping in and purchasing a large number of completed properties by outbidding home buyers. You could argue that the houses could have been made available to home buyers had the project been funded by debt, but that comes back to the argument of where the money comes from and whether or not debt-funded construction is in the best interest of the financial system. Plus, you also have to remember that forward fund agreements are oftentimes in the best interest of the investor in terms of returns, the developer in terms of security, and the housing market in terms of speed of delivery. The second factor to consider is that in the absence of institutional investors, not all apartments would be purchased by owner-occupiers. Data from the Residential Tenancies Board shows that property ownership by large-scale institutional investors in the Irish rental market is still limited, both in terms of the number of institutional investors and the number of rental properties that they own. In other words, the Irish rental market is still dominated by private landlords, meaning in the absence of institutional investors, many of those new apartments would likely be purchased by buy-to-let private investors, i.e. landlords. So in many ways, institutional investors are replacing private landlords, at least when it comes to new apartments. In terms of general advantages of institutional investment in the Irish property market, the Department of Finance notes such firms are investing in high quality, high density and well located units for the rental sector. High density housing located close to key employment clusters generates improved environmental, societal and economic outcomes. Institutional investment provides an opportunity to professionalize the rental sector, to realize economies of scale and to improve regulatory and taxation compliance standards. Many tenants ran into trouble trying to claim the €500 rent tax credit because their landlord wasn't RTB registered, a perfect example of lackluster compliance. I also hear many stories of rental properties, specifically in Dublin, being in poor condition, not fit for living. Institutional investors are providing modern and high quality new builds with consistent quality standards. In terms of supply and demand, the Department of Finance notes that demand factors such as population and economic growth, rising wages and pent-up demand from the Great Recession have led to a mismatch with housing supply. Pent-up demand from the pandemic, as well as the new local authority home loan and the higher CBI loan to income ratio of 4.0 for first-time buyers, could also further extend the mismatch between supply and demand. It was also noted that Ireland's average household size is above the EU average, thereby suggesting a future increase in the headship rate, i.e. the number of heads of households where there is a convergence, which in turn will put additional demand on housing. Talking about Ireland's rent inflation, which we know is significantly higher than the EU average, the Department of Finance notes that in normally functioning markets, this price signal would could result in a supply response. But until recently, capacity constraints in the construction and financial sectors hindered such a response. Market failure emerged as the price mechanism, i.e. rent price increases, failed to induce sufficient supply, resulting in an undersupply of housing. Recent analysis suggests that this response is now emerging, in part due to significant levels of funding from institutional investors. Institutional investors are now deploying large amounts of capital for the construction of new apartments. Given the growth in the volume of build-to-rent investment, a continuation of this trend should result in a significant increase in the national apartment stock. This is nothing but good news for housing supply and indeed the Irish economy, given that sufficient housing supply is needed for continuous foreign direct investment from multinational companies. There are, of course, some potential risks of overinvestment by institutional investors. For example, there could be a high concentration of investors in certain localities, which could result in the investors developing rent-setting power. In Chapelizod, for example, 52% of the apartment stock in 2018 was owned by corporate landlords. There's also the fact that the practice of build-to-rent at present is currently targeted towards the premium end of the rental market, which is unsuitable for renters on low incomes. This, in turn, presents a risk of socioeconomic polarization in the long term. As was indicated in the Hook and McDonald article, one of the reasons why institutional investors are attracted to the Irish rental market is the fact that they can lease their apartments to the state on a 5 to 25 year term, while also linking rent increases to inflation. This is effectively a guaranteed inflation-protected income stream, provided long-term average inflation doesn't exceed 2% over the course of the lease term. Regardless, a very attractive investment proposition, and that's for the provision of social housing. Then we have the matter of taxation. You'll regularly see Sinn Féin challenging Fine Gael and Fianna Fáil on the tax breaks that they give their pals, the Cuckoo funds. Here's the reality of the situation. The two main investment structures for institutional investors investing in the Irish property market are real estate investment trusts, better known as REITs, and Irish real estate funds, better known as IREFs. Let's start with REITs. A REIT is a company whose business involves the ownership of real estate. Crucially, these are publicly traded companies, meaning the likes of you and me can buy shares in Irish REITs. Irish Residential Properties REIT, or IRES, is currently the only active REIT in Ireland since Hibernia was purchased by Brookfield in 2022. The headline that you'll see about REITs is that they pay no tax on rental income from tenants and no tax on gains made from selling properties, which is true. At this point, the fists go up and the public are outraged. However, this is standard practice for REITs all around the world. In fact, the rules that a company must adhere to in order to become an Irish REIT are closely aligned with the rules applicable to REITs in the UK and the US. The Irish government didn't come up with REITs. This model for property investing was already recognised and understood by institutional and private investors throughout the world when it was introduced in 2013. To understand why REITs pay no tax, you first need to understand how you'd be taxed as an individual if you were a private landlord. If you owned a rental property, you'd pay income tax, USC and PRSI on your rental income, and you'd pay capital gains tax on any gains realised from the sale of the property. Now let's say you want to invest in the Irish property market, but you don't want the responsibilities of being a landlord and you don't have the money to buy a property directly. You log into your Trade Republic account and you purchase €1,000 worth of IRES stock. You now have an indirect investment in the Irish property market because IRES A collects rental income from tenants and B owns Irish properties and you own IRES. But here's the issue. If the government taxes IRES on its income and gains, IRES will pay tax at the company level. If IRES then chooses to pay its shareholders a dividend, which is you, the shareholders will pay tax at the individual level. The same income is being taxed twice, whereas if you owned a property directly as a private landlord, you'd only pay tax once at an individual level. So to mimic the tax position of landlords, REITs don't pay tax at a company level. All tax is collected at the shareholder level. But what's stopping a REIT from earning lots of rental income, keeping it within the company and never paying tax? In order to be classified as an Irish REIT, a company must pay out at least 85% of its rental income annually by way of a dividend to shareholders. This ensures that tax is being collected from shareholders just like it would from private landlords. So the headline, REITs pay no tax and therefore the government is best friends with institutional investors, is misleading because it doesn't account for the reasons why the REIT structure exists in the first place. There are a multitude of tenant benefits associated with REITs, including improved improve security and consistent standards of property management. REITs are safer investment vehicles for prospective property investors due to leverage restrictions. They bring liquidity to property market investing, and they offer access to the property investment market to those with less resources. IREFs, on the other hand, are Irish collective investment funds which invest in the Irish property market. Once again, these funds pay no tax on the investment income and gains which arise from their property investments. Fists go up and the public are outraged. However, this is standard international practice for collective investment funds. Ireland operates what's known as the gross roll-up regime, whereby investment income and gains are permitted to grow tax-free within collective investment funds. This is why you can invest in an Irish domiciled accumulating S&P 500 ETF and only pay tax once every 8 years when a deemed disposal occurs. Just because the fund is investing in Irish property instead of stocks doesn't change the fact that it's a collective investment fund, and hence the gross roll-up regime applies. Again, this is to avoid double taxation. If the fund was to be taxed on its income and gains arising from property investments, then the shareholder will be taxed again on the same income upon distribution. Therefore, the fund doesn't pay tax. The tax is being collected at the shareholder level. In terms of foreign institutional investors paying no tax on Irish property investments using IREFs, it is possible. Even though a 20% IREF withholding tax exists for distributions paid to non-resident investors, there are ways around it. However, this is also the case for Irish domiciled exchange traded funds. Foreign investors can invest in Irish funds, avail of tax-free investment growth, and will only be subject to tax in their own jurisdiction. The only difference is that the underlying assets for IREFs concern Irish property, but you can't have your cake and eat it. Ireland can't be one of the most attractive locations for asset management as it is now if it isn't consistent with its tax policies across asset classes. Equally, we can't attract the additional €4 billion in institutional investment that's needed to meet housing demand if we start subjecting the investors to double taxation. You have to pick your battles. So hopefully you've learned something new about the realities of institutional investment in the Irish property market. I firmly believe that anyone who openly describes these investors as cuckoo funds simply doesn't understand the downright necessity of institutional investment. It is a drastic and erroneous oversimplification to say that these cuckoo funds only exist to crowd out homebuyers by outbidding them for residential property. The data shows that institutional investors are largely confined to the new apartment market. An increasing number of developments are being arranged under forward funding contracts, which further weakens the argument for crowding out homebuyers. Institutional investors solve a crucial funding problem for the government, which reduces reliance on both the banking system and the bond markets for financing. While institutional investors don't pay tax at the company level, this is in line with standard international practice for avoiding double taxation. Any individual who claims that the government is palling up with cuckoo funds by giving them big tax breaks does not understand A, the purpose of these tax regimes, and B, the commonality of these regimes on an international scale. Cuckoo funds are not Ireland's enemy, and in the words of the Department of Finance, in the absence of a more balanced view, there is a risk that high-profile transactions could lead to imprecisely targeted regulatory interventions. Keep this in mind if Sinn Féin ever get into government. But let me know what your thoughts are in the comment section. If you enjoyed this video, you can show your support by leaving a like and subscribing to the channel. If you didn't enjoy this video, I'm sure you'll let me know. Regardless, thanks very much for watching, and I'll see you soon.